Yeah.
And I had a look and I was like looking for which stock to pick and what's the next one that can maybe make like 20, 30, 40% next year. And then I had a look and actually in the last years, in average, just this ETF made 22%. So I was like, actually, that's like much better than thinking, okay, which stock will now be the right one if they're already in there anyways.
Well, and one of the things that I'm looking at right now is if you look at the last 6 months, right? I don't know which one you're in. There's a NASDAQ 100 trust that's run here in the United States called the ticker symbols QQQ. It's same thing, right? And if you look at that fund, it's gone up, I think on average over the last 5 years, like almost 30% a year. The only other time it's done that was in the 5 years through the dot-com bubble in the late 90s. And then that ended not so great over the next 5 years, right? So what we try to do also is say, if something, have you ever heard of it? In the United States, we call it reversion to the mean, mean reversion. I don't know if you've ever heard this term. It basically says if an asset class averages, use this example, let's just say an asset class averages 12% a year over time. If it goes through a period of time where it outperforms that mean rate of return by a significant amount, at some point, it will go through a period of time where it underperforms that mean rate of return because the average of all the highs and lows brings you back to the mean, right? So if you go through a 5-year period where this NASDAQ 100 thing outperforms its mean rate of return, might be a good time to consider trimming some of your winnings and looking for something that's underperformed that you can buy cheap. And there's lots of things out there that you can do. You know, we have a mutual fund that we buy that I won't mention the name of it, but it buys dividend based US and international. It's actually about 65, 70% international dividend stocks and about a third US dividend stocks. And where the rest of the market is trading at a PE ratio, in the United States, PE ratio on the S&P 500 is about 22. If you go to the tech or that like NASDAQ 100, you're talking about PE ratios closer to 30. This is paying a dividend of like 4.5, 5%, and it's trading at a PE ratio of 13, right? So it's cheap, it's paying a dividend, and last year it was up 35%. And so it rivaled what much riskier investments did with a much lower risk profile. I'll take that all day long, right? Like,
Hmm.
there's a guy, a wealth manager who runs a big financial investment firm here named Richard Bernstein, RBA Investors, Richard Bernstein Advisors. And he put out an article recently that said, buy what's unloved or unbeautiful, right? Buy things that nobody's paying attention to that are cheap, because the things that have done really so well over the last 5 years, they don't like, the human brain tends to take presently observed patterns and extrapolate them indefinitely into the future. And that's not the way financial markets generally work. You know, it's just for food for thought. Like I'm always happy when people do well, but I don't want people to be so tied to that they write it up and then they write it down.
Yeah, and just because it went up doesn't mean it will continue to go up. So I get your point. Like maybe not loading up on it, maybe trimming. And if you say if you don't trim, at least don't load up when it's
Really
um
high.
expensive. Yeah.
Yep.
Yeah, that's actually one of the challenges as well, is like finding what is the alternative to this investment? What's out there? What's the right one to take? Because of course we have such an abundance now, and with all our brokerage apps, we can buy anything around the world, basically. Um,
Well, and
not
that's a great point,
24/7, but
right?
Monday, Friday.
Just because you can buy anything doesn't mean you should buy anything, right? You got to find what makes sense.